tax-free wealth for real estate investors. We've got Tom Wheelwright here on the show. We're going to dive into a great topic today. One of our favorite, our tax accountant is on the show. My name is Clayton Morris.
I'm Natali Morris.
And this is the show where we help you build financial freedom. The vehicle that we use to do that is buy and hold real estate, but a huge portion of building our wealth has been taxes, right?
Absolutely. Yes. So Tom's book is the book that really changed my entire paradigm about how we ran our family finances. If you don't read it, well, I just don't know what you're doing having anything to do with us, because this is, to me, like the Bible about how you become a wealthy family versus, living the rest of your life as a paycheck family. So thank you, Tom, for joining us. Do you want to tell us a little bit about like the napkin pitch for tax-free wealth? And then we'll talk about why you need to reread it, because I actually am doing exactly that, going back over it now.
Well, because now that you have the second edition, right? So it's totally updated and rewritten for the 2018 tax code, right?
Exactly. And that's the key, is that the tax law changed so much in 2018, the end of 2017, that we really did have to update the new version. And I'll give you just a couple of quick things about the new version. First of all, it's still got the guts of the old version, meaning that it's still about how to permanently reduce your taxes and build tax-free wealth through permanent tax reduction. We're not talking about postponing taxes. We're talking about permanent tax reduction. Second of all, if you look inside, there's actually a link to get a free ebook that goes through the top 10 tax benefits from the Trump tax bill. And that ebook is it's a little bit of my pride and joy right now, because we talk about things, benefits in there that nobody else is talking about. Yes, we talk about the 20% deduction for real estate and other small businesses, and we talk about corporate tax rate reduction. We also talk about things like deducting your inventory. We talk about things like bonus depreciation. We talk about things like the amazing benefit of selling your company and paying no tax when you sell your company. So there are just a lot of great things in tax-free wealth. And, the core of it is, let's live a tax-free life and do the things that the government wants us to do. So that's really that's what tax-free wealth is all about, is really taking advantage of the tax incentives that the government provides for us.
We should mention that Tom is our tax accountant. The team at Wealthability, they handle our taxes every year, and they do a fabulous job. So we'll tell the audience here in just a few moments how they can work with them, and you have to use the link below this video and below this podcast in order to work with them. And he's going to tell us about an awesome program that he's set up. But this show is all about real estate investing, right? And it's buy and hold real estate investing. So when you look at the 2018 tax code, when you look at Tax-Free Wealth, your book, did it add an extra layer of help for us as real estate investors?
Oh my heavens. It's like if you took a wish list from real estate investors and you say, what would I really like to be in the tax code? And then you actually added a couple of bonuses to it. That's what you get with the 2017 tax bill, because it's clear. It's clear what industry the president of the U.S. is in, at the time of the writing of this tax bill, because this is a real estate tax bill. It benefits real estate more than any other single in type of investment, business. There are lots of, we hear a lot about the corporate tax benefits. They're not even in the same league as the real estate tax benefits. Not even in the same league. Corporate tax, they got a 40% reduction. In real estate, you do it right, you got 100% reduction in your taxes. So, just let me give you an example. So it used to be that you could expect in the first year to take about, with cost segregation, we've talked about that on your show before, you'd maybe get a 10% tax benefit the first year if you did a good cost segregation. Now it's over 30% the first year.
Wow, I didn't know that.
So,
wow.
It's
Why?
actually so
because
big.
they've given you more per item that you cost segregate, or because you can accelerate it even more?
You accelerate to a single year.
Oh.
So here's basically what happened is what you were depreciating over 5 years or 15 years is now depreciated over 1 year.
Huh.
So if you do a cost segregation, typically you're going to find about 20% of what you paid for the property goes to land, which is not depreciated. You'll find about 50%, typically, not always, but typically about 50% to the building. And then you're going to find about 10% is going to end up in land improvements and about another 20% in the contents of the building, like the cabinets and the floor coverings and the wall coverings, et cetera. It's those last two, that 10% to the land improvements, the 20% to the contents, that now is deductible in full in the year you buy it, even if it's a used property. I mean, this is what's crazy.
Wow.
In most countries, you don't even get depreciation on used property. And we get this bonus depreciation, 100% of anything that has what we call a class life of under 20 years, which includes all of your land improvements, your landscaping, your outdoor lighting, all of that, plus all of the contents of the building gets depreciated the first year. So get this. If you had $200,000, and we probably haven't talked about oil and gas before because this is a real estate show, but oil and gas historically has been the best tax benefit in the U.S. And if you took $200,000 this year, you could get a $200,000 deduction for that investment in oil and gas, and people would go, "Wow, that's amazing." But if you took that same $200,000, borrowed $800,000 from the bank, and bought rental real estate, your first year deduction would be $300,000.
Wow. That's crazy.
So you actually get 50% more deduction than the money you even contributed to the real estate.
What
It's
if I bought something
unbelievable.
last year and I didn't do a cost segregation until this year? Could I still take that deduction this year?
You can't, because what happened is you elected to not take bonus depreciation.
Oh, okay. So it has to be in the
That's what
year
you
that you
did.
bought it.
So what you have to do is yes, you must take the bonus depreciation in the year you buy it. Now, cost segregation you can always do, and that catches up on your regular depreciation. But what you really need to do is a cost segregation in the year you buy the property.
Right. Okay. All right. Yeah, we had David Brazel on. So if anyone's
good.
listening to this and wants to know what cost
David's
segregation is, it's like a little magic wand. He's the guy to do it. He's great. So please seek that out because it definitely is worth your time and your money. So I remember about 2 years ago in the fall, we did a show with you and we were talking about the predictions about Hillary versus Donald. Mm-hmm. And you said, if Hillary wins, it'll be a lot more of the same. And if Donald wins, well, that's going to shake up my life completely. So clearly that's what happened, without any judgment of those administrations beyond just what it does for us as real estate investors, right? So the big now benefit is that if you are incorporated and you own real estate in your incorporation, then that's just one more huge leg up on not paying taxes on passive income, right?
So can we talk about that a little bit?
Sure.
Okay,
Yeah.
So let me just clarify a little bit. So first of all, the term corporation is a legal term that is specifically a corporation. And we do not want rental real estate in a corporation, ever. Okay? We don't ever want rental real estate in a corporation. I think what you're alluding to, though, is what if I put it in a limited liability company?
In an entity, right. Yes.
In an entity. So, but that's why I wanted to distinguish, because we don't want to incorporate, because if you told your lawyer you wanted to incorporate, they'll form a corporation. We don't want a corporation. We want a limited liability company or a limited partnership, typically is what we're going to use for tax purposes for real estate, for rental real estate. Now, if you're flipping houses, you're flipping properties, you're doing something like that, that's a business, and that's a whole different discussion. But rental real estate, what you guys concentrate on, we typically want it in what we call a flow-through entity, a pass-through entity, and it's typically going to be taxed as a partnership. So that's a limited liability company or typically a limited partnership. When you do that, it may or may not change the tax benefits. What it does is it reduces your chances of being audited to be in an entity. It cleans up your bookkeeping and you actually end up making more money. So even though it's a it costs a little money to do the bookkeeping and do a tax return for it. In the end, what it does is it sets you up like a real business. Remember that the tax law is all about you making more money. I mean, if you think about even a standard business deduction, the definition of what's deductible is something that makes you money. So you should only be spending money anyway on things that make you money in your business, right? If it doesn't make you money, why are you spending the money? So by definition, if you're following the tax law, you're going to make more money. And
so
that's
I have
the
a
whole
question about that distinction then. Okay, so an LLC then is a business, right? And so then is the LLC subject to the 20% new tax rate because it's a business, whereas what I make, say, at my day job, right, is subject to my personal tax rate, but the LLC income now is taxed more favorably, or maybe not because it passes through my personal Social Security number?
So it's actually specific. This 20% deduction, and this is 20% of your net income. So this is a big deal. So if your net income is $400,000, you're talking about an $80,000 deduction off the top.
Wow.
Yeah.
Okay, so this is a big deal. So it does not apply to employees. Okay, it does not apply to a regular corporation, right? Remember, they got their tax reduction from 35% to 21%. So what it does apply to is it applies to any business that's in a pass-through entity. Now, you could own it personally and still get it. Okay, so the entity is not going to increase or decrease. Probably, actually, in some cases, the entity may actually decrease. It's a weird computation. It may actually decrease your 20% deduction. In most cases, what's going to happen is it's going to be the same whether you're in an entity or not. One of the reasons, of course, we put it in an entity, as you've talked about on the show before, is asset protection. The other is it's really good business practice, and it will reduce your audit risk. Because it's a pass-through entity, though, the pass-through entity is what gives us that 20% deduction. It actually has to flow through to you personally, else you won't get the deduction.
Okay, so can I just break this down even further, because I just want to make sure it's clear in my head. Let's pretend I make $10 in my day job, right, as a W-2 employee, and then I make $10 in rental income because I've rented out my 10-speed bicycle through an LLC. Okay, so then the $10 that I made at my day job, I'm going to be taxed at my personal tax rate of, say, 35%. But the $10 that I made in my entity will be taxed at 20%? Or is it not
the
that
$10
simple?
you made, it's not that simple.
Okay.
It's actually, thank you for bringing this up, because
I think that's what the news media makes me think, right? Is that all pass-through entity gets this big break. But it really doesn't work just like that. So when I call our specific guy who works for you, I'm always like, but why? It's 20%, it's 20%, right? And he's like, no, Natalie, let me break it down. So it's just not like that.
So here's how it works. It's a 20% deduction, okay? So it's not a 20% tax rate.
Okay.
So if you think of that $10 that you make as an employee, all $10 is going to be taxed. If you make that $10 in your rental business, only $8 is going to be taxed. That's how simple it is.
Okay.
Instead of $10 being taxed, only $8 is being taxed.
Okay. That
Still
clears
taxed
it up.
at your ordinary rate.
Does that make sense to you?
Still taxed at your regular rate, just 20% less is being taxed.
Okay. I think a lot of our investors come up against this wall is that they think, well, real estate means I can write off all kinds of losses. But a lot of investors who listen to this show make over $150,000, so they have a limit on what they can deduct, right? And so we talked in our previous episode about qualifying as a real estate professional so that you have unlimited amount of deductions. But does the new tax plan help out those people who say, well, I just can't claim all this passive loss because I make too much money?
No, the only thing that's going to help those people is a good tax advisor, because understand that let's say you and your spouse both work full time, like my spouse and I we both have our own CPA firm, so we're not going to be real estate professionals. So what do? Well, remember the rule is Passive loss, which is your rental real estate loss, can only offset passive income. So everybody's thinking about, okay, how do I make it not passive? There's another way to think about it, though, which is the flip side of this. And that is, okay, if I've got this passive loss, how do I turn income, my other income, into passive income? So if I have a business, how do I turn my business into passive income? Well, I mean, let's take your situation. It would be really easy to do. Let's say that you weren't real estate professionals, which I know you are, but let's say you weren't. And you have this business that's making money. Well, you're active in the business. Your kids aren't. Your kids would, if your kids owned it, say through a trust, your kids would be passive in the business. Your kids, if your kids also owned, by the way, the rental real estate, they would be passive in that too. And then those passive losses would offset the passive income from your business. Well, the great thing is, if it's in a trust, who's the trustee? Well, you are. So you control it. It's in an LLC. You're the manager. You can control it. I'm just saying that that's just one way that you could convert active income to passive income.
This is the hack, right? Yeah, you need to be thinking
that's brilliant.
You got to think about both sides of the box.
Yeah.
All you have to think is, look, the rule is passive loss can only offset passive income. So I either have to change the loss from passive to active or change the income from active to passive.
Yeah.
And either one works, and they're both allowable under the law.
For people who do want to qualify as a real estate investor, I had a gal write me recently, and she said, okay, I quit my job. I'm just going to freelance. She's a web designer, but then I want to otherwise manage our rental portfolio. So how do I qualify? And this was the question I had for her. Does listening to this podcast count towards your hours? Because you're educating yourself.
Right. It's education.
Absolutely. Now, be a little careful with this because, first of all, remember the rule is 750 hours or more, right? You have to have more than 750 hours and more than your other business. So you don't want to have 751 hours because you don't want the IRS to be able to come in and throw out 2 hours and you're done, right? Because it's a bright line. So what you'd like to have is 900, 950, 1,000 hours in real estate. And some of those hours need to be something that we would call non-investor or really active hours, which includes you're managing your property, you're working with a contractor, you're actually improving the property. You're doing something that is more than just reviewing your financial statements, doing the bookkeeping, or frankly, getting educated. Okay. Right. So they count, those hours count so long as you also have what we call active hours.
Right.
So being active in the business, but that 750 hours is per year. Has anything changed with the new tax code that addresses becoming a real estate professional?
Nothing at all. Nothing all changed. So there is one thing that very few people know, and that is that your losses. Let's say you have a whole bunch of losses, and you got a whole bunch of income. Your losses, actually only $500,000 of losses can be used a year against other income. Now it's a complicated computation, so you want to sit down with your tax advisor on that. But there is a limitation on how much you can use in losses from your business activities, any business activities against other activities. So be careful about that one.
Something else I am interested in is this expenses for entertainment or client entertainment. It used to be when Tom, you and I went to Coffee Bean, right? I could take that and it was a sort of business expense, right? And now is there some kind of limit on how often you and I can go to Coffee Bean?
No limit at all, Natalie. So the rule only applies to entertainment, not to meals. So meals didn't change. So
we can't go to the movies, or if we do, it's not a deduction.
Go to the movies or the sporting event, that's not a deduction any longer. But we can go. We can go to lunch, dinner, coffee, all we want.
I was going to invite you to the circus, but now I'm not going to.
Because you don't get a deduction, right? Okay, thanks.
I think and when she says the circus, she just means dinner time at our house with our 3 kids.
And here I thought you were talking about to the White House.
Right. Well, that's another circus. That's another circus entirely. When you look at other deductions or other avenues that have changed in this tax code, and I know you can get the ebook and we can go through that. Can you give us maybe 2 more nuggets that we can sink our teeth into here that really make it attractive for a real estate investor right now?
Well, yeah. So we talked about bonus depreciation, which is the big one, and we talked about the 20% deduction, which, by the way, does apply to real estate. It has its own rules for real estate, but it does apply to real estate. That kind of got thrown in at the last minute. Another one is if you're in commercial real estate. Now, commercial is different. Commercial, I mean by not residential. So somebody doesn't live, you're actually doing office buildings or strip centers or something like that. Commercial buildings actually get to write off some things they didn't used to get to write off. They can actually write off a roof. They can write off a HVAC unit. They can write off the security on the building. They could write off fire alarms. So those are things that in the past you could not write off because they were part of the building. And now a commercial, not residential, it only applies to commercial, but a commercial real estate investor can actually write those off. So that's an interesting nugget. That's called the 179 deduction, and it's different from bonus depreciation. Okay, so it's different. And if you have a choice, you always want bonus depreciation. But those 4 items are a little interesting that now all of a sudden they can write those off. There's there's actually this bonus depreciation. There's a little glitch in the law that has not been fixed yet, which relates to leases. And it's not residential leases. We're really talking about commercial leases. And so if you have a commercial lease and you've got tenant improvements, you actually need to sit down with your tax advisor and decide, are you going to assume that the law is going to be fixed or not? There's actually a lot of this that we don't know. So I'll throw out a fun one, I think it's fun. I mean, it's kind of, I think it's kind of fun because it's just, you got to think, how'd this get in the law? There's a rule that if you wait until after this year to finalize your divorce, you don't get to write off your alimony.
Wait.
So if you get divorced by the end of this year, Natali, I'm talking to you. This is your chance. Okay.
Don't give her any encouragement.
Yeah. You don't have to write off your alimony, or you don't?
If you get divorced by the end of this year, you can write off your alimony as long as you pay it.
Huh.
If you wait until the beginning of 2019 to get divorced, your alimony is never deductible.
Well, that tells us another thing about our president, what he likes.
There's clearly some senator. What it is there's clearly some senator that is in the middle of a divorce and figured he would finalize his divorce this year. I don't know who it is, but some senator out there is getting a Republican senator is getting divorced this year. Oh. So if you're, it's a big deal because if you're in the middle of a divorce, then you really do want to speed things up. I've seen clients who they're scheduled for, to go to court in spring of 2019, and that's going to cost you a lot of money. So It's just kind of a weird little quirk in the law. But real estate, the reality is that what with this bonus depreciation, the big deal here is that what you're doing is you're accelerating that bonus depreciation. So you get 30% this year instead of 30% of the total this year. You have to write all of this off this year instead of waiting for 5, 10, or 15 years to write it off. Well, what that means is that you're going to have less depreciation next year. So what that really means is you'd better be planning to buy more real estate next year.
Okay.
Because this year you're getting this big deduction. Next year you're not going to get such a big deduction. You're down to basically about 2% in the second year, 30% first year, 2% the second year. So what you want to do is you want to plan out your investing, and you want to plan it out so that it matches with your taxes, because you want to make sure that you're continually getting the full benefit of all this depreciation. And the way to do it is to buy more and more real estate. It's a little bit of an addiction. I call it a tax addiction because it's an addiction to not paying taxes. And the more real estate you buy, the less taxes you pay.
Yeah.
Right.
So what
buy
we're
until
doing,
you die.
Yeah. So what
That's
we
right.
just did was
call
sign the
we actually
engagement
call
letter
it
for
buy, borrow,
year-end
die.
planning with your firm.
Okay.
So if you have a
Good.
great tax accountant who's in your Wealthability network, then this is something that, like, it's not just you talk to them in April, right? Like, we talk all
Right.
the time to make sure, like, this is what it looks like. If you want to mitigate this taxation, do these things instead, or consider this move or this investment. So, how can people find a great accountant in your network to be doing something like that? Because you don't want to hit that December 31st cutoff, and then there's nothing you could have done about that.
And I mentioned at the beginning of the show, we'll have a link below this that's only for watchers of this show, and it's only for people who've worked with us at Morris Invest. This is not for anybody else. And so Tom and his team at Wealthability have put this together specifically. Tom called me a number of months ago, remember the phone call, and said, how can we tailor a program with our tax team just for people who watch this show and who could use this tax advice for real estate? So can you tell people what they would get if they work with Wealthability, and the link below?
Absolutely. So this is really a very cool program. It's for beginners. I mean, it's for people who are starting out that, you don't have a good CPA and you'd really like some good education, because it includes a lot of education. And our courses, by the way, the courses that we're putting together right now are unbelievable. I mean, we've always had good courses, but the new technology that we've developed is just going to knock your socks off. And what happens is that you will not only get the education, but you'll also get a monthly call with a qualified tax advisor who understands this stuff. And so a lot of people say, well, I don't really want to spend, 3 months developing an entire strategy for my real estate because I'm just beginning. What I'd really like is I'd like somebody to call to ask questions and to have that available to me when I need it. And so what we've done is we've put together a extraordinarily affordable program where you get the education and then you get to ask questions. And by the way, we even set this up that if you want to spend a whole lot of time up front, you can do that, or you can spread it out over the year. However you want to do it, the key is that you've got a qualified tax advisor and you've got the education to back it up.
That's
Yeah,
awesome.
because I've always got a list of questions every month. Like, okay, I don't know about that form. I want to send this in, but am I doing it right? So then you have somebody, who understands your goals and your estate and where you want to get. It's really invaluable because, we had people saying that they would come to you guys and say, well, I just want the Clayton and Natalie, like it's a haircut, that you were able to give. And it just doesn't work like that. You can have these values that I think we have a shared value system with our listeners and our viewers. But it really, you can only you got to do it your way. You got to sort of grow with a great team like yours.
You do. And this is an intro opportunity. This is an opportunity to start working with a tax advisor and really get some education. Does that mean that you're always going to work this way? Probably not. There's going to come a time when your real estate is such like you guys, where you need to sit down and develop a really intensive, complete strategy. And, this program is really to get your feet wet. It's really to get started. And then down the road, you've invested, you're growing, you're doing better. You want to do that. That's okay. That's just called an upgrade. And we just upgrade you. And we just move you into a program that is more suitable to you. What we want to do is we know a lot of your listeners on this amazing program are really starting out and they're looking for something simple and something affordable. And I love this program. It's
Right.
absolutely, we've been doing, we just started it a little bit ago, and it is just working fantastic. And we've just been testing it, and it's just been great. And we love that we're able to share this with you.
If I had this when we started like 8 years ago, I would have,
Right.
it would have saved me. It was really expensive to fix the mistakes that I made because I was trying to figure it all out myself. So it would have been, I can't recommend it enough.
So we've got the link right below. If you're watching this episode, it's right below in the description to work with Tom's team at Wealthability. You have to click that link. If you're listening to this driving, you can visit our website at morrisinvest.com/podcast. It'll be right there. We'll have the link there. It's also in the description if you're listening to the audio version of this, right in the description on your favorite podcast player. So again, you can be set up with a tax advisor who you can spread these questions out over a year, you can condense them, and you can really work something tailored to you. So we really appreciate that, Tom. Thank you for building this program for our listeners and people who work with Morris Invest. We really appreciate that.
You're very welcome. We're happy to do it.
So we're going to wrap it up with this. What is next for you, Tom? What are you focusing on in 2019, 2020, and beyond?
So we are building a worldwide network of CPAs. We have people excited to go in South Africa, in Australia, in Hong Kong, in Singapore. So we're very excited. So I would throw out, if I can, I just throw out a plea. If you do have a tax advisor and you go, wow, I'd really wish my tax advisor, understood this stuff, and I like my tax advisor. I don't necessarily want a new tax advisor. I like my tax advisor. We'd love to talk to them. We're really about not just, our tax advisors. We've trained great ones. We want to train the world. So we want to share this with tax advisors all over the world. And so if you have somebody, please, let Clayton and Natalie know, and we'll be happy to talk to them, because that's where we're going next.
We'll pressure them into doing it your way.
We're literally going to revolutionize and transform a profession.
Well, we've been there. We've certainly had tax advisors in the past that didn't know anything about real estate investing. They didn't understand.
Right.
It was crazy until we started working with your team. It was the difference between day and night, and I think it does come down to that education. So absolutely connect with us, and we'll make sure that your tax advisors get introduced to the Wealthability team and they can get that education. You got to check out the Wealthability podcast also. Tom does a great show. Oh yeah,
you're doing such a great job.
Thank you.
Love that show.
Thank you so much.
You're very kind to have me on the show as well. Thank you so much for that. It's such a great show. Really want to dive deeper into taxes and building wealth by paying less taxes. That's what that show is all about. Tom, always great to see you, my friend. Good luck to you, and we can't wait to see you again here very, very shortly. I'm sure.
Awesome. Always looking forward to it. You guys are amazing and love your education. Thanks for sharing it with the world.
Thanks so much, Tom. Really
appreciate it.
See
you soon at the Coffee Bean.
Or the circus. Thanks, Tom. Awesome stuff. And thanks to all of you for downloading and subscribing. If you're not already a subscriber, please do just hit the subscribe button and share this with someone that you think could really benefit by building financial freedom, because we believe buy and hold real estate is probably the #1 way to build wealth. If you add that together with saving on your taxes,
right, you're golden.
Holy smokes. So we'll see you next time, everyone. Now go out there, take action, become a real estate investor. We believe it's the #1 way to build wealth. We'll see you next time.